Welcome to Energy Thinks, a podcast about the oil and gas industry's role in the energy future. I'm Tisha Schuller, your host and the CEO of Adamantine Energy. We're at a pivotal time, a time I'm calling the moment. Forces are conspiring to lay bare the myth of a simple and quick energy transition. I'm talking to guests about what the moment means for oil and gas industry leaders. I have a great guest today. I speak with Nile Garritson. He's portfolio manager at CalSTRS. You've probably heard of CalSTRS. It's the California Teachers Retirement Fund. And you can imagine that our guest knows something about pressure to act on climate. If you want to explore this topic in more depth, I hope you'll go to energythinks.com and subscribe to my newsletter. Both of these things are true. You can learn more about Nile Garritson's biography in our show notes. I think what you're going to find really interesting is just the pure scale of the investments that CalSTRS makes on behalf of California's teachers and how much money they're investing in the industry and in climate solutions. I hope you enjoy my conversation with Nile Garritson. Thank you for joining me on the Energy Thinks podcast.
Thanks for having me. It's nice to be with you.
So investors are a really important oil and gas stakeholder for obvious reasons. And that is one of many reasons I have been excited to talk to you, Niall. Can you talk a little bit about your work as a portfolio manager and how CalSTRS thinks about its fiduciary responsibilities in this big context that we're all living in around energy and climate?
Yeah, happy to. I'll start with just the very basics to level set everybody who might be listening to this. But we are a defined benefit plan. So unlike a defined contribution plan like a 401k, we do make a promise to our beneficiaries about how much we are going to pay them in their retirement. And we are the second largest pension fund in the country and the largest educator only. And it's a really neat aspect of CalSTRS that we invest exclusively for the state's public school teachers. There's about 1 million of them between active and retired teachers. We manage about $350 billion on their behalf. So it works out on average. Now there's a dispersion, but on average about $350,000 per beneficiary. So it's a very important nest egg to a lot of people who have served the state. Because we make benefit payments monthly, whether the market's up or down, diversification is very important to us, and that influences to a large degree how we invest. And you see that specifically in the public equities portfolio, which is where we have the vast majority of our oil and gas exposure. So our public equity portfolio is nearly $150 billion out of the 350. The vast majority of that is indexed. So we are passive shareholders in the industry's success. And our exposure is maybe 250 equities within the industry, accounting for maybe $6 or $7 billion at any given moment. And in terms of my work as a portfolio manager, there's a few work streams that I'm primarily focused on. One is engaging with companies in high emitting sectors about getting their emissions down and what is their opportunity set that's both impactful and has a reasonably low or even positive economic return, low cost or positive economic return. I'm also involved in voting the proxies at more of the larger cap companies, which is a bit of an undertaking because in total we own about 9,000 equities altogether because we're so diversified. And then I also spend a chunk of time on a private portfolio that a group within our team manages, where we are investing about $1.5 billion on average. That's our target, about $1.5 billion on average in climate solutions. So companies or technologies or projects that meet our hurdle rates, because making money is our number one priority for the teachers, that meet our hurdle rates and also have a positive climate impact. And there we're looking for things that where the unit economics stand on their own without subsidies, and we're not facing sort of binary outcomes, extreme success or extreme failure. And a lot of what I do there is around due diligence. So taking learnings that we can glean from companies in our public portfolio, certainly oil and gas companies, and use that to inform just how valid some of the opportunities are that we're looking at there. So there's a few work streams that I'm involved in altogether, and all of them to a degree really touch on the oil and gas sector.
Well, first, I just want to acknowledge the humongous responsibility you have. There's a bunch of teachers in my family, both on my side and my
Same,
husband's
yeah.
side. And so, well, first of all, shout out to the teachers, most important job on the planet. And second of
Right
all,
up
we
there, yeah.
want them to have a nest egg that it successfully provides for all the teachers in their retirement. So, but yeah, how do you sleep at night? Like, so much responsibility, Nile. And then I imagine, I mean, those numbers are just staggering, right? Like the amount of investments that you have to manage in this, in this context of climate and energy being just such a big marketplace, but also such a big like political force and conversation to be reckoned with. I'm curious. I imagine you have to think very carefully. It sounds like you have a huge portfolio that includes investments in oil and gas, and I'm curious about how you think about your role in how you make those investments. Like, what's the role of reducing emissions? What's ESG priorities? And when you look at oil and gas companies, do those things matter in how you think about where you invest into oil and gas companies?
The on the public side, sort of the blunt answer is no. But the reason for that is because of how we approach investing in public markets, which is very different than how we go about it in private markets. In the public market space, I think we're a big believer that while there is some role for active management, and I did spend a good chunk of my career in active management, when you're investing kind of at this scale, with equity exposure of approaching $150 billion, and you couple that with the need for diversification and consistency of returns, it really pushes you pretty firmly into an area where indexing makes a lot of sense, because you can get that very broad equity market exposure. You're going to get market competitive returns, which is really, really important. And it's also very hard to do that at that kind of scale, if we're honest. And then we work on controlling what we can control, which is our costs, our overhead costs, and our investment fees, which is a big focus for the fund, kind of across the board, but certainly within the public equity space. On the at least within the private investments that we're making on our term, that is much more of a bottom up, sort of fundamental deal by deal diligence and capital allocation process. But there, we do have investments that touch the space, but it's indirectly, technologies that either support the industry or are borrowed from the industry, but not direct investment. We're not typically, investing in some of the household name, oil and gas PE funds, or doing, co-investments directly in some of the larger private companies.
And
but then
go ahead.
Sorry, go ahead. I would say, your question touched on how do we think about emissions within the oil and gas exposure that we have. I think, we as a defined benefit plan, we have a very, very long time horizon. So when you think about the spectrum of shareholders at any given public company, certainly any publicly traded oil and gas company, our results are not going to be defined by kind of the next quarter, the next cycle, and what happens there. It's really going to come down to how much terminal value is there. And so with that in mind, even though we're not active stock pickers, we are engaging the companies actively on issues that we think will potentially have an impact on their terminal value. So that it kind of runs the gamut. But I guess first and foremost, with the amount of scrutiny on the oil and gas industry specifically, because that's what we're talking about here, we're actively engaging them to do things that we think are in all shareholders' interest to preserve the longest tail of terminal value.
Yeah, and I want to just pull on that thread a little bit more, because when you and I sat together and talked about this, I was impressed at just frankly at your nerdiness, like your nerdy understanding of the methane emissions space. And so, can you talk a little bit about why, as an investor for teachers, you understand this stuff so well? In what ways do you imagine that emissions reductions will affect terminal value?
Sure. I appreciate the compliment, but I do want to acknowledge humbly that one thing I really appreciate about the industry is that no matter how much you think you know about it, there are subject matter experts in the industry who have spent their entire careers working on some of the most nuanced issues, and the amount of knowledge that exists out there with the complexity of our energy system is just astounding. So, always underestimate that at your peril, right? Um, but fortunately, I'm friends with a number of folks in the methane space who really are, sort of the black belts on the topic. So they help keep me up to speed, if you will. But I guess how we got on the subject of methane is something that's important to us. If that's really what the question's getting at,
Yeah, yes, it is.
is you know climate change is a big concern for us, and why is that? It's because we are so diversified. We're basically what a lot of folks would call a universal asset owner. We own so many equities, so many. We have look through exposure to so many PE companies and so many individual pieces of real property, real estate around the world that our fate is tied to the success of the economy and the success of society to a very large degree. And so for big systemic issues, and we would put climate change in that bucket, we can't just sidestep it. And so we feel we have responsibility in terms of protecting the assets of the fund to do what we can within the scope of our jobs as investors to try and address it. And but we also recognize that we don't own control stakes in really any of these companies, especially on the public side. We'll typically own 15, 20, maybe 25 basis points of and we have many other shareholders who may or may not share some of our priorities. So we think about it the way I think a lot of oil and gas companies, or at least a decent number of them, think about addressing their emissions. We look at, except in our case, we're not looking at individual companies' sort of abatement cost curve or opportunity set. We're looking at the world's marginal abatement cost curve. And a few things jump out when you do that. One is that there's some really low-hanging fruit, and then there's some hockey stick, more like moonshot type opportunities that are going to take technological revolutions and a lot of money to solve. But at the low end, sort of at the lower left hand side, methane really fits in there. It's largely, I would say, I'm going to broadly characterize this. I know there's exceptions, but it's largely low cost or even net negative cost or generates positive return. It's actionable. Right, and it's becoming more actionable almost every day with the number of vendors coming to the space, the technological solutions that are being developed, and it's also material enough to matter. With methane from oil and gas operations, sort of loosely accounting for maybe 3 to 4, possibly 5% of global greenhouse gas emissions, and it's also impactful. Right, I mean, methane doesn't last that long in the atmosphere relative to carbon dioxide. It's very powerful. So if we can start addressing this now, we can really start getting the amount of methane in the atmosphere to roll off, at least from oil and gas operations. And of course, that's not the only source of methane. And then we own, again, about 250 equities in the industry. We tend to talk to the larger ones for the most part. Let's be clear. But it just checks a lot of boxes for us.
Mm-hmm. You hit so many interesting threads in that. One, just the scale of your investments, I can barely get my head around. And then this idea of climate, and both climate and energy as these macroeconomic forces that are so central to having a successful economy. That I think that might tee us up well for the real reason I wanted to have you on the podcast, was to get your take on what I'm calling the moment, and that's how this world that we live in, where there has been a pretty oversimplified narrative around climate and around the energy transition. And I think in the moment, we're all starting to understand that the energy transition is a lot more complicated than we thought. And I really appreciate your nod to the black belts of methane. So we gave a nod to the teachers. We'll give a nod to the black belts of methane. Like to all the nerds out there, we love you and thank heavens for what you do, and the details that you are willing to tend to, because to address the energy transition with as much speed as possible, we actually have to understand the complexity. We actually have to understand the details, or at least value the people that do. And so what I'm curious is, in this world, Nile, where you both have to think about like the macro health factors that affect the economy, but also the very nerdy elements that will affect the ultimate value of, for example, companies or even sectors. Like, what do you think? How do you think your stakeholders think about this? Like, are they, ultimately you have to deliver returns at the end of day. Are they thinking pragmatically about energy? Are they thinking about the importance or longevity of the role of oil and gas? Or is this something that you have competing tensions that you have to work with in your work?
Yeah, there's certainly competing tensions. There's no question. But I think in terms of whether folks in our orbit, are thinking pragmatically about it. I guess the one thing I would say is, I touched on the complexity and the scale of the industry a moment ago. It's hard, even for me sometimes, having followed the industry for a long time, to really grasp the scale of it. And so it's hard to think pragmatically unless you really have that window into just how many, literally hundreds, sometimes thousands of touch points we have with hydrocarbons in a single day. I mean, sweep your eyes over any room or any environment you're in. As long as you're within a town or a city or something. I mean, it's the vastness of it is really hard to grasp. So, for folks who haven't had that window, I mean, it's hard to fault them for maybe not fully appreciating, how enormous an undertaking it is to decarbonize a system like that. So is that kind of what you're getting at?
Yeah.
Yeah, yeah.
It's funny. Just yesterday, I was having a conversation with someone and brainstorming again about these factors. And he said something like the US power grid is the biggest machine in the world, like just its interdependencies. And if you start thinking about like just that, right? Just power, just the interdependencies, the fuels, all the things that come out, how it gets to our homes, like the enormity of our efforts is it's startling. And so I'll just continue with this thread a little more. In terms of like your job ultimately is to drive returns, not play politics, I'm guessing. But like, do you have to attune yourself to these sort of, I don't know, I guess the polarization there is around energy and climate?
Yeah, we do. There's no question. I mean, I would say, look, I worked at a publicly traded electric utility here in California, starting 6 or 7 years after the blackouts that we experienced here in the state in the early 2000s. The people associate Enron with, and sort of the formative lesson from all that, having gone through the blackouts as a resident and then working at a utility that in the aftermath that had been exposed to financial challenges as a result, is that when the lights go out, people will not tolerate it. And that leads to discontent and upheaval. And so when we think about advocating for an energy transition, we have to take issues into account like affordability and reliability. We can't jump past those, solely in pursuit of decarbonization. I mean, again, I want to be clear, like decarbonizing is very important to us, but it has to be done in a way that works and is affordable for the most people possible. And I think we believe it is possible. In terms of the political tensions you mentioned, it's kind of a funny, not funny, but interesting topic for us. Right? One thing I feel really confident in saying about like my colleagues and the staff and the people above me that I report to here at CalSTRS is that everybody is laser focused on the mission of securing the teacher's retirement, like first and foremost, and that is in the state constitution. That is our number one priority as a public pension plan. Excuse me. So the political winds are certainly there, but we have a lot of support up and down sort of our group of stakeholders to pursue this in a way that is consistent with making money for our beneficiaries and reducing the risk that they're exposed to. So I guess that's a really, really long way of saying, people have certain stereotypes about us if they don't know us, but they actually, in the end, really don't always hold up.
Yeah, I have that stereotype of you before I talked to you, so I totally would have expected that too. I think what's nice about what you're describing, Nile, is that ultimately, when you have a clear mission to, especially a mission that's so important, secure retirement for teachers, that the big picture success of the energy transition, which means it's affordable, the power doesn't go out, the gas stations, if we have, if we need them, have gas, like that, there's sort of a predictable, managed, affordable energy transition. Like all of that is part of the ultimate success of this massive portfolio you have. In many ways, your mission transcends like wherever the winds blow. Now, I imagine that doesn't make you exempt though from like being targeted for action. Do you get pressure to divest from oil and gas? And if so, do you have a strategy around the kinds of companies or the kinds of expectations you have in order to be more on the scales of working with the best and most successful, best in class oil and gas companies?
Yeah, we do have that pressure. There's no question to divest from the oil and gas industry. And in fact, occasionally I do receive inbounds from activists who want us to divest from other industries and specific stocks, some of which I find kind of surprising, although I won't name them in the interest of staying on track here. Our thinking about that is that we truly believe, and I think we are proving it, that remaining shareholders of these companies, just purely from a climate point of view, is making them better. And I know of things that some of the bellwether companies have done, partly, not fully, but partly as a result of our involvement, our requests, our dialogue with them. And there's just no reason to believe that some of these things would be happening, but for the involvement, not just of us, but other shareholders who share some of the same priorities. On the flip side, what we look for, but we have not found, is evidence that if shareholders like us blow out of these stocks, to the thousands and thousands of other hedge funds, mutual funds, separate account managers that are out there, or individual investors, retail investors who may or may not share our same priorities, that will somehow result in the world's emissions being lower than they otherwise would have. We cannot find the evidence. I mean, if it exists, we're 100% open to finding it, but we just have not. And again, it's been the opposite. We see the evidence that being involved, remaining involved, keeping our seat at the table, and asking for things in a constructive manner that we think benefit ultimately all shareholders is far more impactful.
That makes a lot of sense.
Than if we were not. Yeah.
Yeah, that makes a lot of sense to me. And I'll even put in, I'll even take your observation and raise it one, which is that in the context of this scale of action that will be required to continue down the path of decarbonization in service of a high functioning economy where energy is affordable and reliable, we need these humongous companies engaged in the transition. We need them bought into the project, and creating somehow energy teams to me doesn't make sense.
Right.
It's not in our shared enlightened self-interest.
Tisha, I have to jump all over that point, because I think one thing, I don't know if I should admit this, but is the truth, is that one thing I've come to appreciate just in the last couple of years or so since I've been here at CalSTRS is the scale of what some of these companies can bring to bear with respect to transition and decarbonization is unmatched anywhere in the world, in terms of the technological know-how, the size of the balance sheets and the cash flows supporting them, the scale of the organizations, and I would say the spirit that and probably a lot of your listeners fully appreciate about the industry, which is that there's an attitude of, when you cut past all the politics and stereotypes, there's an attitude of problem solving and optimism around being able to solve big challenges, in many forms. And if we were to think about, well, how much time, how much money, how many false starts, and would it take to replicate, from scratch, what this industry is able to bring to bear on the transition? I mean, it's almost unthinkable.
I really think that's an important point, because there's an interesting, I think, expectation. Part of the oversimplification when people imagine an easy energy transition is that startups with new tech are going to do stuff, but we don't have time for a billion tiny startups to figure out how to build humongous energy projects. And so putting that, as you said, there's the capital and the know-how, and then there's just the ability to pull off really, really difficult engineering feats at scale.
Yes.
And that among people who've done that and walked the walk and figured it out. So yeah, I really appreciate that. And I should give a little more thought to, and I want to spend more time thinking about this idea of just the generic enthusiasm for solving problems among the industry is unmatched. Everything the industry tries to do is really hard.
It's very high. No, I mean, when you think about just the ability to coax oil and gas out of rocks that look like concrete,
right?
I mean, you just sort of go from there, but that gives you the flavor right there.
Right. Let's decarbonize. Okay, it's just a different engineering problem. Let's get going. Well, I really appreciate, Nile. I think you've given our listeners a flavor for the way you use your mission to transcend and create sort of directional continuity in your investment work and your engagement with companies. But I imagine that because both you probably get the stereotypes go in many directions. People probably love to vilify you for working at CalSTRS or vilify you for investing in a bunch of companies or whatever. So I'm curious for you individually as a leader, how do you stay positive around all of this conflict and polarization out there? What keeps you going in this thoughtful, like nerdy way that I so appreciate about you?
Thanks. I think what keeps us positive and optimistic is the sort of daily wins. I mean, I don't mean that in a literal sense, but the small wins. Maybe that's a better way of putting it. The small wins that we see just time and again across different companies in the industry. And I'm not trying to say the industry is just all benefits, no costs. I mean, we're fully aware of that the industry brings big benefits and sometimes big costs to society. But the little victories that we're just seeing coming constantly from the industry about getting those costs down and getting those benefits up. I mean, it just keeps coming. It's not just this industry, too, but that's the focus of what we're talking about today. And another thing that gives me optimism, well, there's a bunch, but just one example that's in front of my mind is, like, I think 3 weeks in a row, I went to 3 different methane conferences. There's one at Stanford, then there's one at Colorado State, and then there's one at University of Texas. And I like to show up and just soak it up. Network with folks, find out what's going on, what's new, interesting, exciting. Just the sheer number of people going to these things from different verticals. So, people from the companies that we own stock in, technology vendors, academics, and yeah, even some investors too. I mean, people are mobilizing to solve issues, to solve problems. Now, I'm just talking about methane here, but there's other verticals too, and it's really encouraging to see the optimism and sort of the diversity of folks from different walks of life who are showing up to try and make a difference.
I agree. Those conferences, probably 10 years ago, it was like the same 12 nerds at, at those events.
No,
And now
that's
it's
right.
literally
Right.
hundreds of people and maybe dozens of vendors, at any one event. The brain power that is combining to solve these issues is truly extraordinary. And I appreciate,
Yeah.
Nile, actually that you trouble yourself with the details, because the details do matter. That's how we're gonna succeed at these things. So I have a final question for you now that I ask all my guests. What are you most optimistic about?
I would say that, but maybe to be more concrete, I think of this as kind of a generalization. Um, I am optimistic. This is probably a big statement, and the industry's got to prove it. I'm optimistic that the industry is going to be able to fully measure and validate the methane intensity of its molecules from the wellhead all the way to the regas plant and its overseas LNG export customers. I'm optimistic that's going to happen.
I love that your optimism is so nerdy, Nile. You've just proven my my enthusiasm for the details. I'm just so grateful that you do the work you do now. Thank you for tending to such an important portfolio and to such an important stakeholder group, the teachers. And thank you so much for joining me on the Energy Thinks podcast.
Yeah, it's great chatting with you, Tisha. It's good to see you again.
That's our episode for today. You've been listening to Energy Thinks. Thank you to our listeners for giving me a reason to engage in so many interesting conversations. And thank you, Nile, for joining me. What I found compelling? We covered it at the beginning. $350 billion in investment, $150 billion invested in oil and gas companies, $1.5 billion invested in climate specific solutions. Like, the scale is enormous. And the way that CalSTRS has to balance, like what's good for society in the macro, it's just such an important lens to be thinking about the moment and the energy transition. I hope you are enjoying what you're listening to. If you can take a moment and review us on your podcast app, that will help other listeners in the oil and gas industry find us. I would love it if you took a second and went to energythings.com and signed up for my newsletter. Both of these things are true. I'd like to thank Kayla Chieves for making the Energy Things podcast possible. Until next time, I'm Tisha Schuller, wishing you and yours happiness, prosperity, and good health.